Crypto headlines are bullish. Ethereum ETF flows are up, regulators are finally aligned, and institutions are quietly loading up. But your portfolio? Probably stuck. Bitcoin hasn't broken past 120k. Ethereum stalled under 4k, and most altcoins are bleeding. For a market that's supposed to thrive on momentum, this kind of silence feels a little off. And for most people, it is frustrating. My name is Danilo, and today we're going to unpack what's really going on beneath the surface. I'll walk you through the mechanics that drive these flat periods, the macro conditions that are quietly suppressing risk appetite, and why even the most bullish headlines aren't enough to move the needle, at least not yet. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. One of the biggest reasons crypto prices can just suddenly drop, even when the news isn't bad, is leverage. Right now, it's playing a huge role in why the market looks weaker than it really is. In crypto, traders commonly use leverage to amplify their bets. If you're trading with, let's say, 5x leverage and the market moves against you by 20%, your entire position gets wiped out. When too many people are leaning long, even a small dip can start a cascade of liquidations, and that's when things really start to accelerate. We just saw that happen. Over 800 million in leverage positions were liquidated in a single day, and Ethereum alone made up more than 260 million of that. It wasn't triggered by some major event. It was just the result of overcrowded positions and weak hands getting flushed. When liquidations kick in, traders are foresold out of their positions, which drives the price lower, triggering even more liquidations. This creates those steep drops that seem to come out of nowhere. You don't even need a big headline to spark it. Something as small as price stalling at resistance or a vague macro headline is enough to set it off. Crypto is still a thin market. It's emotional, highly reflexive, and most of the time it's just reacting to where their liquidity is stacked. That's why you see wild price swings that you don't always make sense of. First, you get a drop from long liquidations, then you get a pop from shorts getting squeezed right after. Nothing to really do with fundamentals. If you want to make sense of this stuff, start tracking liquidation data. Sites like CoinGlass let you see where longs and shorts are getting wiped out in real time. It won't explain everything, but it gives you a decent sense of whether price is reacting to actual news or just cleaning out overexposed traders. That's the phase we're in right now. The market's not really panicking, it's just resetting leverage before it decides what comes next. Even when things look good on the surface, price often tells a different story. That's because in crypto, like in every other market, liquidity is what actually moves prices. Not headlines, not hype, and not even strong fundamentals. If the broader macro environment isn't supportive, the crypto market struggles to gain traction, and right now, that's exactly what we're dealing with. Just a few days ago, US jobs data came in weaker than expected, with only 73,000 new payrolls added and revisions lowering previous months by over 250,000. At the same time, unemployment ticked up, and the Fed is now under pressure to cut rates sooner. And on top of that, Trump just rolled out a wave of new tariffs, including some targeting Canada and over 60 other countries. These kinds of developments spook markets, especially ones as risk sensitive as crypto. In theory, weaker economic data and rate cut expectations should be bullish for assets, but it's not really that simple. When the narrative shifts from soft landing to recession risk, investors don't rush into risk on assets, they get cautious, and crypto sits at the far end of the risk spectrum. So even when macro tailwinds are forming, like rate cuts or more government spending, markets often stall until there's actual confirmation. That hesitation gets priced in through sideways price action. This is why we're seeing flat charts despite the bullish headlines. It's not that the headlines are wrong, it's that the macro backdrop isn't stable enough yet for capital to flood back in. Traders and institutions need conviction, and without it, the liquidity stays parked on the sidelines. And when there's no fresh money coming in, even good news barely moves the needle. So, if you're looking around wondering why the market isn't reacting at all to the so-called bullish catalysts, zoom out. The headlines are bullish, but the liquidity hasn't followed yet. Until that changes, expect more chop than breakout. Over the past few months, we've started to see a real shift in crypto regulation, and it's surprisingly positive. The SEC just launched something called Project Crypto, which is their plan to bring financial markets on-chain and support tokenized assets. That's not something we would have expected a year ago. At the same time, the White House's Digital Assets Working Group is backing the idea of giving the CFTC more authority over crypto spot markets. In simple terms, the US government is starting to speak with one voice, and it's no longer saying, quote, get out. This is a big deal. The crypto space has spent the last few years dealing with enforcement by surprise, lawsuits, shutdowns, unclear rules. But now, with the Genius and Clarity Acts moving forward and leadership changes at the SEC, we're seeing a policy shift towards actually enabling growth instead of trying to stifle it. That doesn't mean the US is suddenly crypto's best friend, but the tone is changing, and that matters. The thing is, the markets haven't really reacted. These developments haven't translated into price action because they're still early. Policy changes are slow, capital flows even slower. But for longer term builders, traders, and investors, this kind of regulatory clarity is foundational. It's what sets the stage for institutions to re-enter confidently. It's what makes tokenization real. And it's what helps remove some of the uncertainty that's kept serious money on the sidelines. So if you're wondering why all this bullish regulation isn't causing a rally, it's because we're still in the setup phase. This isn't a headline traders can jump on right away. But it's one of those background shifts that tends to matter a lot more a few months down the line, when no one's really paying attention anymore. One of the most anticipated moments in recent policy news was the Trump administration's updated report on digital assets. A lot of people were hoping for new details around the strategic Bitcoin reserve, the government's stash of seized Bitcoin and its future plans for accumulation. But when the report dropped, there wasn't much substance. No updated numbers, no clear acquisition strategy, and no transparency. In fact, Bo Hines, who leads the White House's crypto council, dodged direct questions about how much Bitcoin the government even holds. That silence didn't build confidence. At the same time, we've seen spot ETF inflow slowing down after a strong start earlier in the summer. Bitcoin ETFs, which were pulling in billions, have now tapered off to more modest levels. Ethereum ETFs had a short burst of momentum but also cooled quickly. What this tells us is that the easy money, the initial surge of interest, is likely behind us at least for now. The market's no longer reacting to the headline of quote ETF approval. It wants to see real volume, real impact, and continued demand. That shift matters. It's one thing to have bullish infrastructure in place, reserves, ETFs, policy support, but if it doesn't translate into sustained inflows, the market sees through it. Traders aren't reacting to headlines anymore, they're looking for follow-through. And in this case, the lack of clarity around the Bitcoin reserve combined with a slowdown in ETF flows has left the market unconvinced. Sometimes the best way to understand the market isn't by looking at headlines or the charts, it's by watching how people behave. And right now, sentiment feels stuck. Not overly bearish, not euphoric, just uncertain. Most people aren't buying aggressively, but they're also not panic selling. It's that in-between zone where no one wants to be the first to move. Part of this hesitation comes from the rally we just had in July. Bitcoin and Ethereum both posted strong gains, and altcoins briefly followed. But instead of sparking a full trend, that move created a pocket of indecision. Some traders took profits, others tried to rotate into lagging coins, and now most are just sitting back, waiting for confirmation that the next leg is real. This kind of sentiment, flat, cautious, low conviction, is exactly why markets stall. You have the bullish catalysts, but no one's willing to lean in. Volume drops, volatility fades, and we get stuck in a sideways range where both bulls and bears feel equally unsure. For retail investors, this often feels like dead time, but for funds and smarter money, it's usually where positioning happens quietly. The noise dies down, people stop paying attention, and accumulation starts to build again under the surface. It's not really exciting, but it's important. At this point, the big question isn't, quote, why isn't crypto pumping? It's, quote, what would it actually take to make it move? And the answer almost always comes down to three things: liquidity, catalysts, and timing. You don't need all three to spark short-term volatility. But if you're looking for a real breakout that holds, they need to line up. Liquidity is the fuel. When money is flowing, either through rate cuts, ETF inflows, or increased risk appetite, you start to see capital come off the sidelines. And that's what gives price room to expand. But fuel alone isn't enough. You also need a catalyst, something that sparks attention, moves sentiment, and triggers action. That could be new policy shift, a major partnership, or even a macro surprise that flips the narrative. The third piece is timing, and this one's the hardest to pin down. Sometimes a strong catalyst shows up when liquidity is low, and nothing happens. Other times, markets are primed, and even a minor story can cause a huge move. That's why some of the biggest rallies in crypto happen when no one's watching, because the conditions lined up quietly before the headline ever hit. Right now, we're not quite there yet. Liquidity is improving, but it's not pouring in. The headlines are bullish, but most of them have already been priced in. And sentiment is still cautious. Until those three pieces come together, we're more likely to see consolidation and false starts rather than a sustained breakout. So here's where we currently are. Leverage just got reset, macro conditions are still shaky, regulation is finally shifting in a positive direction, and sentiment is stuck in neutral. The headlines might sound bullish, but without the right mix of liquidity and conviction behind them, they don't move the market the way you'd expect. It's not about the news, it's about what the market's ready to do with it. This kind of environment frustrates a lot of people. It feels like you're doing everything right, paying attention, staying informed, and still, nothing's happening. But flat markets aren't a waste of time. They're where real positioning happens. The smart money uses these moments to prepare and not really to panic. So, the question is, what do you think flips the switch? Is it a Fed pivot, a surge in ETF flows, or something we're not even paying attention to yet? Drop your thoughts in the comments. I'd love to hear your take. If you found this breakdown helpful, hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next update. Thanks for watching, and I'll see you in the next one.